guys. A lot of you have been asking me to cover off the Greeks, so I thought I would take the opportunity to kind of cover that today and talk about what each one is, how it might be used, and its purpose. So we're going to start off with the delta, which you probably hear the most. And this is kind of your options speedometer is a way to look at it. So the delta measures how much an options price is expected to change for every dollar move in the underlying stock. So it's a kind of a rough estimate of the probability that the option will basically finish in the money or not. A lot of people, for call options, it's 0 to 1, put options 0 to -1. A lot of people like to put this as a percentage, and the way to sometimes think of this is if you have a delta of 20%, it has a 20% chance of it actually going into the money. So, and being exercised ultimately. We'll look at some options chains in another video, and we can look at the delta numbers to give you kind of an idea of what this means. But you can kind of see as if you've got a strike of 100, and if we look at the call delta, you'll kind of see this where it's 40% as I get very close to the strike. But as we start to, drift, you can see that number, drifting in the opposite directions, depending on which way, whether it's a put or a call option. So I just thought I'd quickly cover that off, just so that people understand the delta side of things. The gamma is a slightly different measure. The way to think of this is while we had the speedometer here, we've now got the accelerator pedal. So gamma kind of measures the rate of change of an options delta. So it tells us how much the delta will change for every dollar move in the underlying stock. So basically a high gamma means delta changes very rapidly. And so gamma's kind of for out the money options, especially those with little time left at the expiry. This kind of creates a significant risk and an opportunity depending on which way you look at it. So we can kind of see like the gamma for a 60-day option is kind of all flat. And then when you've got a 7-day, you can kind of see the kind of value peak here. Okay. The theta is, think of this as almost the countdown clock. The theta quantifies the time decay, the amount of value an option loses each day as it approaches its expiry date. The decay is not linear though. It can kind of accelerate dramatically in the final end period. If it was a monthly option or weekly option, obviously that will change depending on the duration. But in a 90-day, let's be the final 90 days as you got closer to expiration. So the thing to think about with theta is it's kind of the buyer's foe and the seller's friends. Option buyers have sort of negative theta, losing value daily, while option sellers have positive theta, profiting from that decay. So depending on which side of the fence you are at, theta can be important. Okay, if we look at Vega then. So Vega is kind of, think of Vega as the volatility. So Vega manages the option sensitivity to 1% change in the implied volatility, often referred to as IV. So basically a higher IV driven by market uncertainty or fear increases an options premium, basically benefiting the option holder. So, what we do have, like we had the trade tariffs recently, like we've had some of the conflicts that is impacting Vega, the volatility, in fact. So Vega is highest for long-term options at the money. Obviously, at the more time, the uncertainty gives the stock market more potential time to move. So it's again just about thinking around if we had a long-term option, we've then got the sensitivity to time and then sensitivity to the actual premium or moneyness of the actual option itself. Obviously, if we've got a short-term at the money option, that's going to be a lot more sensitive to the moneyness and the premium than it will be to the time. So again, different ways of looking at these things. Okay. The last one to look at is the rho, which is the interest rate thermometer. So Rho measures kind of sensitivity to a 1% change in interest rates. So often, I would say probably the least relevant of all of them. But if you've got long-term options like leaps, then obviously interest rates can have an impact. So think of it from a cost of capital perspective. Higher rates make holding cash more attractive, which in turn makes the right to buy a stock, basically a call, more valuable, and the right to sell a put less valuable. So that's probably the only way to look at Rho. As I said, I would say in terms of kind of looking at this overall, people tend to look at the delta as their primary thing when they're picking stock options. And that's what everyone always asks, what delta are you setting? Gamma is sometimes used, but it depends on the type of stock that they're running it on. So sometimes for the more volatile ones, for example, they might look at it more actively. The gamma, theta rarely people look at general as the retail ones. So it really is these top two. As I said, delta is probably the primary one that everyone tends to look at. Okay, so in terms of the actual kind of strategy matrix, if you're expecting high volatility, i.e. large price swings, direction uncertainty, you're going to focus on the Vega and the Gamma. We will talk a little bit around strategies that could be applied to options if people are interested in. I'm not sure they will be. It might be a bit a stretch too far right now. But, depending on that, you might use certain option strategies like long straddle or strangle. Obviously, if you're expecting some level of price stability, the stock to stay in a sort of narrow range, you typically see this for like low vol stocks, typically. The ones that don't tend to move that much, like maybe Apple, doesn't typically move that much unless there's some news that's come out, or Google, whereas the high vol ones might be a MicroStrategy or a Coinbase. This is where you might focus on, the positive theta and delta, and then you might run strategy like a Iron Condor or a butterfly. If you're kind of expecting volatility to kind of go down, then this might be after an earnings announcement. Maybe, Tesla's announced they're not selling so many cars in UK or Europe due to competition from, let's say, BYD. This is when you might run a short straddle or a calendar spread, and your focus would be on the Vega. So again, depending on the types of strategies, depending on the types of direction taking, will depend on the Greeks that you look at. One thing to kind of mention here is this is why it's so important that when these funds get the ability to have more flexibility in the types of strategies they can use, they're able to be more actively managed and prevent any kind of real losses within the fund. They've got a lot more opportunity to capture those premiums and potentially the upside that you want to capture. So there you go, guys. Hopefully that was a very quick overview of the Greeks. Again, as I said, this is probably a very selected audience that this will be interested for. I know some people have been asking me around what the Greeks mean, how do they work. Recommend you go back and watch this a few times, because it probably doesn't sink in the first time. I know it didn't for me, but hopefully I've tried to give you as much context as I can. All right, there you go, guys. I will catch you on the next one.